All right, let's go. Strategies to survive and thrive. And the idea for this panel came together after a conversation with Dennis and Andy. And the idea was, look, you have such a group of real estate leaders. These are some economic times that many people have never navigated before. And could we arrange a panel with different experts in different asset classes? And there was one small condition, is they all had to have gray hair, because we wanted to give you the most amount of knowledge that you could ever possibly find to help you survive and thrive in commercial real estate. Dennis Bernard is the founder and president of Bernard Financial Group, Michigan's largest commercial mortgage banking firm with more than 33 years of experience. He specializes in debt and equity placement, overseeing billions of dollars in commercial real estate transactions. Ladies and gentlemen, Dennis Bernard. Matthew Lester is founder and CEO of Princeton Enterprises, a Southfield-based real estate acquisition, development, and property management company that enjoys one of the finest reputations for successfully repositioning and operating a diverse portfolio of commercial, industrial, and multifamily assets. They've acquired more than 165 properties with an aggregate value of $1 billion and operates more than 24,000 apartment units throughout the Midwest and the Southeast. Let's welcome Matt Lester. And we have Akram Namou of the Namou Hotel Group, CEO and founder of Namou Hotel Group. They own, operate, and manage a portfolio of hotels that span across Michigan, Indiana, and Ohio. His expertise and strategic vision has grown the company from one hotel to being the largest private company in the Midwest, a man I affectionately refer to as the master, Akram Namou. Lowell Salesin is a partner at Honigman Law Firm and one of the chairs of their real estate department. He's been practicing for more than 30 years and has developed both his developer and lender client and has helped both his developer and lender clients. It's been a long day. Navigate through their best and worst real estate cycles. And he is thought of by his clients as a critical part of their team as they approach acquisitions, development, construction, financing, joint venture, and real estate dispositions. He really couldn't miss an opportunity to sit on this panel and then send them all a bill. Let's welcome Lowell Salesin. David Schostak is CEO of Schostak Brothers and has more than 40 years' experience in all aspects of real estate development and finance. He has been responsible for over $1 billion of development, redevelopment, financing, and refinancing of the company's portfolio properties. That portfolio includes shopping centers, office buildings, industrial buildings, land development, and mixed-use developments, and over time has included more than 100 properties in 25 states. Uncle Fun, David Schostak. And our maestro for this, a man who has supported every aspect of my career and really has never found a way to say no to me. And I appreciate him doing that. More than 27 years of experience in accounting, finance, asset management. He's the president of the Farbman Group, and he's also an author, father, and a husband, and a dear friend of mine, and a friend to this real estate community. Let's welcome our maestro, Andy Gutman.
Good afternoon, everyone. Oh, it's been a long day then. Good afternoon, yeah. Thank you, appreciate that. When Derek asked me to be a part of this panel in particular, I thought there is not an easier job on earth than to have this amazing group of experts. And I'm just going to say go, and they're going to take it away from there, and I'm just going to sit and maybe have a drink. So we'll get started on the afterglow a little early. But really honored to be a part of it with truly what I think is just an amazing panel of incredible real estate people. So soak that in. You'll never see Lowell Salesin outside the office again after this today. I've never seen him outside the office in my life, but we'll jump right in. All right, gentlemen. What are the current commercial real estate market trends, and how can investors capitalize on them? It's a really broad start. And let's start. We'll start with you. You're the only one actually I can see behind this thing, so I'm going to be staring at you the whole time, David.
So I'm going to let the others answer the meaty portion of this question.
Oh,
there's one thing that
David, do you have a microphone?
Right, I'm sorry.
Do they work?
You usually don't need it.
Hello, is this it? Is it on?
Usually I'm so loud I don't need a mic, but ask my nephew over there, he'll tell you that. But I think the important part, the way to start this conversation is what I think is a trend going on in the media, and I look to all of us in the industry to help straighten it out, and that is this terminology of commercial real estate. And what does commercial real estate really mean? And very often we hear this thing that commercial real estate is headed for a downturn, or commercial real estate has all kinds of issues going on right now. And quite frankly, what they're talking about, and they're not wrong, is office buildings. But the balance of the food groups, the balance of the asset classes, whether it's industrial or retail, or Akram will tell you hotels and land development, other kinds of things, are actually doing quite well. You know, maybe they weren't doing as good as when interest rates were zero, but we've all seen them do a lot worse than they're doing now. It is, to be sure, office buildings are in a crisis, both suburban and urban. Downtown Detroit may be a little bit of a different phenomenon. And I think it's important for us in the industry to make sure that we differentiate between office buildings and the balance of commercial real estate, and don't let everything get kind of gobbed into the same thing. Office buildings are an issue. We are wondering what's going to happen post-COVID with office buildings. Occupancies are down. There's no debt available for them. We do have, as Dennis can speak to, significant amount of maturity defaults coming up because there's no place to refinance these properties. And so I don't mean to undersell the issues with office building, but I would go out of my way to start this conversation by differentiating between the rest of the asset classes and office buildings.
Can I jump in there? Because I think that what David is saying makes a lot of sense, that the terminology gets jungled up and gets lumped together. My position on market trends, and I like to speak to the 20-something-year-olds in the room who are just starting out, is there are no market trends right now. We are living in a time where there's almost perfect chaos, where there's winners and losers. Some people are doing tremendously well, others are not. And so it's very hard to make those kinds of generalizations. You want to make a generalization about real estate? We all know that a couple years ago, we were buying, if you bought, you were buying at 4 caps or 3 caps, and debt was very plentiful, and maybe you were buying floating rate, and you could buy high leverage, and if you did that, you may be sitting in this room with a problem. But for many of us who didn't, we were on the sidelines. Now we are off the sidelines, and really we're in a situation where there's a little bit of chaos, and chaos equals opportunity. In terms of metrics, you take any issue, and I'll bet the 5 of us on this panel would agree. Whether you're talking about interest rates, we could take either side of the argument. Interest rates are too high and they're stifling development. That's what Charles had said in the retail panel. Interest rates are normal. They're historically low. That's what Andrew Kuhn said on the multifamily panel. So whether it's interest rates, whether it's inflation, whether it's operations, it's sort of a perfect world in terms of chaos, which creates opportunity. And so I think it's kind of go time in terms of that. And so I would take the metrics and I would treat them as noise. And what I would do is I would stick to real estate fundamentals. Situations, a perfect real estate situation where you're looking for the right asset in the right location at the right price that underwrites properly, and I'd hit the go button.
Let me follow up on that. Andy, it was a really good question. David was spot on with how to identify, Matt, winners, losers, opportunities. What we're seeing now is during the run-up after the Great Recession, there was opportunities and people did very well. There was low interest rates, significant increases in rental rates, COVID even for some. Sorry, Akram, at first it was a problem, but for almost all the other food groups, it was successful outside of office. We saw booms in certain parts of retail, definitely in industrial. But the opportunity we're seeing now, and Matt hit on that, is for those seasoned older guys, which all of these guys I've done business with for years. They didn't have those opportunities because they weren't buying at 4 cap rates. They weren't building at 4 cap rates. They weren't developing at unrealistic numbers and based on lower than historical interest rates. But now interest rates are just at a historical, regular norm, and lenders, this is the time for opportunity to pick up from lenders. Our firm already in the first 6 months of this year, we've already moved 12 properties from properties that were in defaults to different ones of our clients for opportunities to buy. And they're buying them at the right, if it's office, at the per pound square footage. Or if someone over leveraged an office on a floating, multifamily, they were able to buy them. Akram, we're going to start seeing hotels now too. Some of the things that were purchased, as you saw, and you were scratching your head, why are people doing this? And I know Lowell and I have worked together on several of these. So to build on what David and Matt said, the opportunities are there. They're just different opportunities. And those who kept their portfolios intelligent, kept their cash squirreled away and didn't put it all away, they're going to see tremendous opportunities, as we've seen after, the S&L crisis, after the dot-com boom, after we saw after the Great Recession. We're going to see that again now, and those are where the opportunities are. But again, you got to still, just because it sounds cheap, doesn't mean it is. You got to buy it right.
And I would add, Andy, this is like the kind of question we could answer this for the rest of the afternoon. But I would add one thing important that I think everybody always has to remember, and that is how you structure your deal and making sure that you can look around the corners. And someone once taught me this, and it's still to this day, I think it may be the best legal advice I will give to everyone here today. A good deal with a bad partner is a bad deal. Yeah. And think about what I just said. A good deal with a bad partner is a bad deal. And so, a deal that you structured with someone who was supposed to bring the capital to the deal, or, he had a relationship with Dennis and he was going to get the financing. When you don't have that, when you don't have a good structure, when you don't have a good legal foundation to your transaction, when the world changes, and it will, you may not have the ability to do what Matt's talking about, or to be able to pivot and look at your asset again and say, instead of doing this, we're going to do that. So your documents, your structure, that's what's going to give you the ability to take advantage of the opportunities that Matt and David are talking about.
2 quick notes. Never convert an office building to a hotel. Just, I have done my homework. I have really researched, explored possibilities. It is very highly costly proposition. Unless you are in a very, very high-end downtown, maybe there's a possibility there. But in any normal circumstance, don't do that. Second point, when you structure a deal, and me being a CPA by profession, when you structure a deal, structure it right from tax point of view. When you acquire something, an office building, and you want to, structuring that deal from tax aspects is extremely important. That's what I do. You get the write-ups, you get the depreciation, and some incentives along with it from the city and the counties. So when you structure a deal, do it the right way from tax point of view.
All right. Thank you, gentlemen. Well, we're talking about some of the challenges right now, and we talk about, David mentioned office is the most challenged, but I think we'd also argue that there's some others in multifamily or other areas that are heavily on the watch list, but not being addressed because office is so horrendous at the moment. What kind of strategies are you using, or can people use to mitigate the challenges they're facing right now, specifically in the office sector, but in any other area where there's some potential exposure?
Well, the office sector is definitely tough. There's just no doubt about it. And I think what we have to consider as it relates to office is the following. In 2008 and 2009, the famous Great Recession, office buildings went, in the toilet, so to speak, and they went back to lenders, and a lot of people made a lot of money buying office buildings very cheaply, very inexpensive, and filling them up and selling them. And in this town and other communities, I'm sorry, I keep forgetting about that. This town and other communities were very successful in doing that. The question is this time different? is there really a fundamental shift in how people work, where people work, and are they ever going to go back to suburban office buildings, in particular in our marketplace, like they were before? And therefore, is this a fundamental change in these buildings? I suspect it is. I think that people, remote work is maybe not going to be the only way it goes, and a lot of people, ourselves included, want people to come back into the office. But we clearly need less office space. Technology is making a big difference, and I think that there is a, for lack of a better word, a permanent oversupply of it. And then the question goes, what can you retrofit these buildings into? Or what Dennis suggested is, how cheap can you buy them? And is it even cheap enough? I'm working on a couple of them right now, and Dennis always reminds me, do you want it at any price? Which I think is a fair thing. Akram was very bold, and it was great to hear that. Don't think you're turning them into a hotel, okay?
Or apartments.
So that was my next question. I was going to turn over to Matt and say, Matt, can you convert these damn office buildings into apartments, or is that also smoke and dope?
The short answer to that is no, you cannot. And but to go to sort of what Andy was getting at, how do you mitigate risk in volatile times? First of all, I think the answer is you embrace volatility, okay? Don't be afraid of volatility. Volatility is what creates opportunity, right? But the title of this panel discussion is Survive and Thrive. And if you talk to any one of the five of us, we all spend some of our day in survival mode. David's hitting on it now, right? And you were hitting on it in terms of surviving by not making the mistake of converting hotels or office buildings to hotels. And it allows us, if you spend a little bit of time in that survival mode, to then flip to where we really want to be, which is thriving mode. How do you mitigate risk? And tell you one thing, just looking at this panel, you hire Dennis Bernard to finance your properties. Then you know that you have a sure thing. You hire a Lowell Salesin to be your legal counsel. By the way, the saying, to shorten it, is you cannot do a good deal with a bad person. That is the saying, and it is a truism. But what is the number one way? The number one way, David was talking about whether this is a permanent change and stuff like that. Some things will stay the same. They will stay the same. What is the number one way to mitigate risk in real estate investing? Capital reserves, cash, staying power, right?
Yeah.
Liquidity, cash, your balance sheet. That's it, okay? That's number one. That hasn't changed. What's a kissing cousin of a strong balance sheet? Deleveraging, or not over-leveraging in the first place, okay? Those are the two fundamental strategies to mitigate risk. Structure is another one. How about structuring a deal that is more favorable to the investor dollar that you want to be more patient? Okay? That's a way to mitigate risk. We could sit here all night and talk about risk mitigation, working harder, which I love the way the other panels talked about morality, working hard, taking care of customers, taking care of employees. All of those are risk mitigation strategies. But number one is the balance sheet and financial staying power.
And I would add to that, understanding your loan documents, understanding the commitments that you've made. I'm spending a tremendous amount of time helping clients sell great assets that, frankly, when they bought them, they looked at me and said, this is for my grandchildren. And now we're selling them to create the liquidity that Matt's talking about to solve the problems on the deals that they over-leveraged and that they can't get enough money, despite Dennis's hard work, to pay off the loan that they have in front of them. And I have clients who tripped recourse carve-outs on loan documents by accident, made transfers that they didn't realize, and now all of a sudden their non-recourse loan is a recourse loan. It's hard to negotiate with a CMBS lender who you want to give the keys back to when they have your org chart and they know that the loan is actually recourse. And so part of mitigating the risk is knowing what you have, knowing what your documents say, and making sure that you're negotiating from a position of strength, and you don't end up putting yourself in a situation where you have to sell off the good assets to solve the problems that you've created.
I want to take it one step further, and Lowell and I do a lot of work together, both on the upside, and now we're doing it some of the management of the downside. But it's about relationships more so than just the documents. When times are good, develop deep relationships with multiple lenders. And don't, if they're 5 basis points, David's great at this. If a certain lender's 5 or 10 basis points less, but it's someone he's had a long-term relationship with, they stay with them. And lenders remember that. Matt does that all the time too, all the time. And again, that develops relationships. So when things get difficult, and David, I'm not saying anything people don't know. David has some office buildings. The relationship was his opening comment, if you don't mind me saying this, his opening comment to the lender for the office building is, we borrow the money, we can't pay it back. What would you like us to do? It's my problem, not your problem. And it's very disarming. And at that point, the lender says, I've got a partner with this borrower. I know what the documents say, and you're right. That's a very good organization at making sure they keep their documents clean. Matt, you keep your clean. I would assume with your Akram, you keep your documents clean so you don't have troubles. At that point, in a situation like this, you have a lender who's not looking to foreclose or to go after the carve-outs.
Well, in reality, wait a minute, Des. That's not that they like me. They just don't want the damn building.
Right, but if you go to them with
Why would they?
right, but if you go to them confrontationally, they'll come at you confrontationally. If you go to them, and right now, David and I and his family are deciding at what, it's funny, the lender and David keep pushing the keys back and forth across the table. I don't want it, no, you want it. How about a little less? Oh, no, yeah. But at least those are the relationships. And the reason that's important, then, not just your capital partner, your lender, but also with your equity investors that you talked about. Liquidity. If you have, a lot of people made mistakes in the last 10 years, they went high leverage and they got equity investors who aren't deep pocketed. When times get tough, you always have to think about your deal that you may have to go back to your equity investors to write a check. And if they don't have the ability to write a check and you have to go get outside equity and there's cram downs and everything, there's tax consequences, there's breaks up of partnerships, there's things that happen, so it's just as important to, even in the good times when you're building and buying your properties and structuring, you structure them tax-wise, good documents-wise, but Matt, you have deep equity partners that they've won with you a lot, so if they have one that has a little issue on it and has a little carry, it's no big deal. Relationships.
I just want to add, we've been through really two major upheavals and downfalls. The 2009 and 10, 8, 9, 10, and of course the COVID era recently. Especially for hotels, there was never tougher times than those two periods. A lot of people surrendered their hotels, but relationships with bankers are extremely important, and how you negotiate your loan documents to start with. Again, to be honest, I went through hell or tough times during the 2008 and 9, but I did not give one brick to any bank. So that went in because of the background, relationships, negotiation with the bankers, because both of parties will lose. If I give them the hotel or the property, they will lose. They don't know how to manage it. They don't know how to run it. They don't know how to even, get even management companies. So working together with the banker, with the lender, is extremely important, and your background is important.
Just real quick too, when you're talking about relationship, let's dissect relationship real quick. It may be simple, but let's do it anyway. Everybody keeps talking about relationship. What is at the heart of a relationship? Communication, okay, honesty, okay, hard work, okay, and your ass on the line too. Don't ask anybody else to do something, expect them to do something that you wouldn't be prepared to do yourself. that is the essence of what turns into a long-term working relationship.
I'm going to give everybody my first lesson in real estate. I was in my 20s, and it was my very first banker. If there are any elder statesmen in the room, it was Manufacturers National Bank, which now is part of Comerica. And I was in my 20s, and he calls me on the phone. He says he wanted to go to lunch with me. And he was, on the surface, a conservative-looking banker. This was probably the early 80s, so 40 years ago. And white shirt, tie. He used to joke about being conservative from Grosse Pointe. So he sat down for lunch, and he says, I can tell you're going to be my customer. He said, so I want to teach you a few things I want you to carry on, and I've just told this story in any audience I could possibly do, and there's some bankers in the room, and every time I tell it to a banker, they all nod. He said, this is my message to you. Number one, I don't do deals. He said, I loan money to people. He said, so it's very important to me who you are, where you came from, and what you do is way more important to me than a deal, because I won't even understand the deal as well as you do. So it's the people, it's the person who I'm loaning the money to is number one. He said, the second thing I want to tell you is everyone thinks bankers are conservative people and we don't take risk. He said, that's not true. He said, we really do understand risk. We really do understand that at times a deal goes bad. He said, but let me tell you what bankers are horrible at. He said, surprises. He said, so you remember this, don't ever surprise me. He says, if you got a problem, the last thing I want to do is hear about it from someone else in loan committee. He said, communicate with me. If you got a problem, you can tell me about it, we'll be able to work it out. So that lesson I have now taken with me for 40 years in business, and I've repeated this story to every time I meet a new banker or someone else, a capital source. And if I could recommend anything, it was Dan McDougall in the early 1980s that I owe that to, and I've used that in my entire career.
It's a very good lesson, no doubt. Going back to relationships, though, let's talk about the reality of that. And it's great with bankers because you have a warm body that can give you answers right away. Dennis, maybe you can speak to this better than anyone, but CMBS lenders, can you form those relationships that can make a difference if you do get in trouble?
You can't, but I can.
That's fair.
Why can't I? That's a bold, big statement. Even for me, for anybody who knows that. I make a lot of bold statements, but even for me. Why? Because you wanted to have a relationship with people who think they go direct to get a CMBS loan. They're going to one of the CMBS originators, or they go through a discount broker firm that sends it out. If that firm itself does not primarily service the loan, my firm, Bernard Financial Group, we service all of our loans right here in Michigan. So in other words, we collect the payments, we approve the leases. If there's a problem, David calls me up first or whatever, or anybody else does. We service the loan. So therefore, remember, in CMBS world, they sell the paper. So that great relationship you had with that banker, doesn't matter. You did it with JP Morgan, doesn't matter. They don't have the paper. Do it with Morgan Stanley. Citi, doesn't matter. They sold the paper. So you have to develop relationships with your primary servicer, who we have relationships with. I just show Lowell right now. We have a mutual problem loan, and the special servicer, the master servicer is misbehaving. So I just sent an email to the head of the special servicer, who emailed me right back. Pick up the phone, give me a call, let me see if I can solve the problem for you. So you have to make those relationships. How do you do them as the borrower? You have to work with firms that are primary servicers. There's another firm in this room that's a primary servicer. We share best practices on how to deal with these awful, did I mention awful? Master servicers. That's how to do it. So choose how you go to your CMBS lender appropriately.
I would add, right now, sort of June 2024, the CMBS loan is sort of coming back fast and furiously. We're doing probably more CMBS loans. I probably have worked on more CMBS loans this quarter than I did all of last year. and I've closed billions of dollars of CMBS loans over the last 25 years. And so it is remarkable, and the reason they're coming back is because you can get more loan proceeds, basically, right? These loans are, the leverage is higher. They're a little more creative on trying to manage through the debt service coverage constraints. And so all of you are going to start looking.
And they're lending on product type that others aren't.
Right. They are there because there's a demand for it. And so all of you are going to start seeing it again. And what I want you to remember is one size does not fit all. And you got to really understand your property, and then you got to pick the right CMBS lender. You got to have the investment and the time to make sure that you know what rules are in those documents. And so you got to be very patient. But it is without question the busiest lender we see right now are the CMBS lenders.
I agree.
I would agree with that too, by the way. We love CMBS loans, even though your question was loaded, Andy. Can you form a relationship with the CMBS lender? And the answer is basically no, if you're a guy like me, and Dennis pretty much said that. But their execution is outstanding. So if you know what you're going into, that can be a favored kind of loan. And frankly, a lot of the distressed real estate that we are going to see over the next couple of years is going to be CMBS loans, and it's going to be Dennis, or it's going to be somebody like him who does have the relationships with them. And so if you're just one relationship removed, if you have the relationship with Lowell or Dennis, to being able to do business with them on distressed real estate. So
I would add, my last resort is CMBS loan.
what's your first resort?
Credit
Me
unions,
too.
Credit unions and local banks are relationship-based financing. That's the priority, or that's the advantage you get in resolving problems, in communicating, sit down for lunch, do whatever you have to do to resolve that problem. But CMBS loan, as he said, you don't know who your banker is after a month. So, and they are very rigid, much tougher documents, loan documents, very demanding, and to the T. So I would keep it as a last resort. The good thing about CMBS loans, there's no restriction of cash out. A lot of banks have somewhat limitations when you refinance. They give you more really valuation, more proceeds, and do whatever you want to do with the proceeds. No limitation like the local banks where, they want a relationship, they want deposits, they want other stuff. So
Well, Tim Khalil just put his hand up and said he's got no limitations on any of his loans.
But I'm with Akram. I swore I would never do another CMBS loan, and just show you how Dennis and Lowell are right, I'm closing 2 this month. And you know why? Because I had loans coming due, and there were no other place to go to refinance them. So I'm with Akram on it.
If you want to do,
Dennis is right, by the way. These servicers have the relationship. Matt is right. Borrowers can have it directly, and the servicers can have it.
If you want to do deals in the oil fields in North Dakota, your execution is CMBS, isn't it? DB?
That's the ones who are doing it. That's the ones who are doing it. That's why when times are good, also match, be careful of, don't fall in love with a certain type of borrowing. Match your assets that you're buying with your liability, which is your loan. A lot of people got in trouble because they didn't do matching. What do I mean by that? They went to banks and credit unions and did float, and they bought them based on 3%, 3.5% interest rates. They leveraged up based on that. They kept them floating. They did no caps, no collars, no hedges, no nothing. And then when the rates moved, suddenly they were upside down. And Akram, as you know, the bank comes calling and says you need to right size your loan or put up more equity or whatnot. So if you have commercial property that has long-term leases, fixed rate leases that you cannot adjust your income to, match it with a life company or a CMBS lender that has long-term fixed rates. So make sure, even in the good times, that you match appropriately the kind of real estate you have.
Makes a lot of sense. And along those lines, while we have on that topic, Akram, what's your position on recourse in terms of your loans?
yes, when you are confident of your ownership, management, I do recourse. most of my loans are recourse. Why? First of all, you have to have faith in the property and the operation. So, again, liquidity, I go back to liquidity. If you have strong liquidity, don't be afraid of recourse because the bank will always work with you. So, as I said, my opinion, the last resort is a CMBS loan, non-recourse, which is good, but any deviation, any glitch in that loan, it's a very big damage. Well, the banker, we call each other, we work things out and compromise somewhere.
Can I just jump in and say that I agree with Akram, but let me tell you just a little bit different take on it, and mine is a different take. What Akram is saying, first of all, almost any loan that you get, whether it's recourse or non-recourse, the reality is that you're, in your soul, in your heart, you are standing behind it. But if you want to buy $2 billion worth of real estate, by the way, this panel's talking a lot about hard times and workout and stuff like that. It's not all bad out there. We're crushing it in some sectors. Let's get to that in a minute or two. And if you are crushing it, or if you are on offense, okay, and I mean, I'm talking about the offense where you want to double the size of the company the way that the Bell Tire retailer did, who was here for the commercial panel. The way that the formula for it, my formula for it is you're going to take down, is Tim Khalil here? Where are you, TK? TK's in the back, okay? There's no better bank lender than Huntington and Tim Khalil at it. And there's a lot of good ones. Maybe somebody tied, but nobody better. The execution to take a deal down with a bank line, which is going to be full recourse, is going to put you in a competitive advantage to be fast, first, and get the deal done. However, I only have so much firepower with Tim or any other banker or all of my aggregated bank lines, okay? So my strategy has to be, whether I'm confident in the real estate or uber confident in the real estate, and there's nothing other than that, confident, okay, is that debt has to move to non-recourse in order for me to reload and find the next deal so that I can be fast and deliberate and execute. Okay? So the strategy for many of us in the business that has worked is to form the relationships with the bank, put your personal balance sheet and your relationship and your reputation behind the deal, borrow recourse, stabilize the asset if that's necessary, have some trailing, whatever it is, 3, 6, 12 month, whatever, deliver it to an end lender so that, among other things, you're back in business with your lender to be able to pull the trigger on the next deal. Make sense?
Thanks.
I would just say, I mean, when one of the first things I say on behalf of any of my clients is we don't sign guarantees, okay? So I think that it's good practice to
It's really good to be a lawyer.
right, it's easy to be the lawyer, but it should be the exception, not the rule, because as Matt said, ultimately the goal is not to have the guarantees out there, and you should understand what your guarantees are and what they mean. A lot of people look at Fannie and Freddie loans and they say they're non-recourse loans, but the truth with Fannie and Freddie is that if you default on a Fannie or Freddie loan, you'll never do another loan with them. So it is really a recourse loan to a certain extent. And I have a lot of clients who come in and say, well, I only signed a 50% guarantee. And I say, well, what is the chance that that real estate is ever going to be worth less than half of the loan? And they say 0. And I say, so you've just really guaranteed the whole loan. And so each deal has a different reason for a guarantee, and you got to analyze each one, and you got to understand if you're giving the guarantee, why are you giving it? And a plan like what Matt described is the right plan.
Thanks, Lowell. David, any thoughts on
Yeah,
that?
the only thought I would have, and again, just met Akram for the first time, but he and I tend to agree, is, and I'll give you this example, and I told you I never would do another CMBS loan, and I'm telling you I'm doing 2 this month, so you can take whatever I say.
I'll never do, but I said the last resort.
Right. But I would say, and this was the last resort this month, but I would say this is the question I would ask. if I, and Lowell touched on it with partial guarantees, if I have a stable, leave aside our development business, we're at the development stage or the early acquisition stage, like Matt said, there's generally going to be recourse involved in order to be, on a construction loan and to lease it and to get through stabilization and all those kinds of things. But this is the question you'd have to ask yourself, and I bet you where Akram comes out on it as well, is would I rather go to my local bank, go to Tim Khalil or somebody like that, and guarantee, let's say, the top 20 or 25% of the loan, where I think the likelihood is it's stabilized asset, and I always know I have somebody to talk to. I don't have to be worried about cash flow sweeps. I don't have to be worried about cash traps. I don't have to worry about reserves and insurance reserves and tax escrow reserves and all those kinds of things that you have to do with a fully non-recourse CMBS loan. And our philosophy over the years is I'd rather know the person across the table, and in order to have that person across the table, he needs a partial or she needs a partial guarantee from us. We've been prepared to do it for having the privilege of knowing who it is that we're talking to, because like everyone says with the CMBS, you don't. So I guess on balance, I would say to you, we're more in that area of it, but yet, like I said, I speak out of both sides of my mouth as we close 2 CMBS loans this month.
But that's why God created the perfect compromise between that, and that's life company borrowing, where you can do it non-recourse, no reserves. You don't have to do deposits. You don't have to put in quarterly reports to see if you got to right size the loan. All they care about once you do a life company loan is every month send in the payment. If your debt coverage goes from 2 down to 1.05, have a great day. Just make your payments. And when there's a problem, you get on the phone with the same person you met when you had the loan closing, the application, the process, and everything with the life company, and you start to work it out.
But typically much lower leverage, though.
Well,
What's wrong with that?
Instead of 70, 65 or 70, depending on the product type, it's 60 to 65. So it's a little lower, less amortization, 25-year amortization or 22-year am.
But
So
no cash sweeps, no reserves, none of the escrows,
no
none of
asking
the
for
stuff
permission.
that bothers you.
You want
And,
to peel something off for a out parcel? Sure, come talk to us.
Yep.
But that's why I talk about when you do your development, figure out what is the best. Is it banks, credit unions, which we love? Is it life companies? Is it CMBS? Is it debt funds? Is it agency? Try and match your property with the right capital source.
All right, thank you, gentlemen. I'm going to direct this to you, Matt. Previously, I've heard you use football metaphors to describe, where we are in the current trends. And as it relates to multifamily, are we on offense or are we on defense right now?
Who said both? We're on offense. I'm always on offense. And as a real estate entrepreneur, I'd like to encourage anybody else who's entrepreneurial to think that way too. But there's offense and then there's offense, right? So the last few years, offense, to use football offense, might have looked like 3 runs into the middle of the line and punt. Okay, that's offense, right? Now it's loosened up a little bit. And I'll tell you why. There are 2 reasons. One of them is there's some distress in the marketplace. I think Dennis and I were talking about the fact that I don't know how you would put it, Dennis, the number of defaults, CMBS defaults in the month of May was equal to or larger than the previous 6 months. Did I say that right?
Absolutely perfect.
Okay, so there is some distress in the market. There's also distress in the market that has stemmed from the fact that those owners of real estate, I'm 59 years old. When you're 79 years old and you missed that 3-4 cap rate, okay, and cap rates are starting to rise and interest rates are starting to rise and your kids or your grandkids don't want that real estate, it may be time for you, whether you want to call it distress or not, to unload the assets, okay? We are finding that has changed recently, and so it's put me on offense. Here's the other thing that's put us on offense in the multifamily business, and it's interesting because you had a phenomenal multifamily panel this morning. Who was here for that? Anybody here? They were phenomenal, okay? But they missed a couple things. 2 things that I didn't hear either of them say. Andrew Kuhn talked about the shortage of supply, of apartments, okay? Which is true. What's the flip side of that? We still have pricing power. We still have rental pricing power in the multifamily sector across most of the United States. Sans, maybe San Francisco or whatever, some distressed markets, okay? We have pricing power, which is phenomenal. We did not think that we would have that 6 months ago. We thought we were plateauing. But there was an article about single-family development build to rent.
Right.
Build to rent in the Wall Street Journal a couple days ago. Does that bother me? Shadow markets of rental housing? No. What do you think the rents for that real estate are going to look like? They're going to be up here. So between some distress in the marketplace, some generational turnover, okay, we met with a guy in Cleveland yesterday who's 81 years old, and it's time. And in light of the fact that the fundamentals of the apartment business are still quite good. Expenses have risen, but guess what? Pricing power has equaled that, if not outstripped it. So we're on offense. There's some good news. How about it?
Love it, love it. Akram, would you say the same thing about hotels?
For hotels, really, hotels had a golden era between after the downhill of the 2012-13 up to 2019. That period, we saw a lot of expansion. The hotel business was thriving. After the COVID, the picture changed. I'm sure you know, the COVID impacted, the first industry was impacted is, tourism, hospitality, hotels, etc. And now we are seeing the impact. There were a lot of hotels in the pipeline because of the thriving period. We bought a lot of lands to build, and I'm one of them. So after the COVID, with the banks tightening up dramatically, with the financing become more difficult, the construction, we had to finish those that were in the pipeline. That created oversupply. So a lot of hotels, even to the current day, we are finishing what we had planned to do, what was in the pipeline. And you are bound by franchise agreements, you have to build. They might give you a little bit extra time, but eventually you have to build those. Otherwise, there's liquidated damages. So we continued building, finishing our projects till 2022, 23, and that created oversupply. So there's a lot of more hotels than really the demand, definitely in certain areas. And then you don't meet the ratios, you don't meet the requirements of the loan covenants, that's another problem. So it all depends, how strong you are, how confident you are of your, again, management operation to survive. So to me, there is currently a lot of hotels on the market for sale. I don't know if you are in that field, a lot of hotels are in the market for sale. Why? They cannot do their renovations, number one, because they don't have the funds. The franchises are being more tough because there's a lot of competition between Hilton, Marriott, IAG, and everybody is racing. There's more new brands coming up to the market. Marriott is coming up with a couple of brands every year. Then Hilton, then IAG. They are copying each other to capture the markets, whether it's extended stay, whether it's budget, whether it's mid-scale, and so forth. So I feel there's going to be a lot more defaults on CMBS, number one. And a lot of hotels are currently in the market to buy. But they are not cheap because, again, the cost of construction has risen so high. So there's, there's always limitation of new construction. So definitely, it's a riskier situation than before.
Thanks, Akram. How about you, David? Any of the sectors you're in you want to talk about?
Yeah, I would say there's two asset classes that were on the offense. My nephew, Jeff Schostak here, I refer to him as, forgetting this, I'm sorry, is my exit strategy, but he has done a phenomenal job over the last 10 years finding a niche in an asset class of what I'll call B, industrial warehouse distribution space. Done an exceedingly great jobs, found a lot of assets for us to buy that just needed a little bit of love and care, and we've been able to lease them and finance them and or sell them. And we're on the offense in that area. Finding the product's harder than it was, so I think maybe it's tightened up a bit, so it's a little harder to play offense, but we're still very active in that space and are still would like to be a buyer in it, in the older B, like I say, industrial warehouse distribution space. And we've also been a consolidator across the country of shadowed anchor centers that sit on the pads of super Walmarts in small and medium-sized towns across the country, county seats, a lot of places you haven't heard of. And we've been an active buyer in that over the last 10 or 15 years. And likewise, there's another asset class that we remain bullish on, and we are on offense buying them. In both situations, it's a little harder to play offense because there's still a differentiation between what I'll call sellers' expectations and buyers' reality, which is a function of higher interest rates. So with interest rates, I'm not suggesting I agree with everybody, they're not historically high, but after 10 plus years of basically zero, they're high in relationship. So people's expectations are different. So it's a little harder to play offense in those two asset classes because of interest rates in the debt market, but we're still bullish on them from all the traditional points of view.
I would double down on industrial too. As David said, I know maybe nobody's done it better than Jeffrey in the room, but the industrial market has been a very, very good place to play the last 5-6 years. I suspect that there's still a few acorns out there for us squirrels to find. The fundamental reason I think that the industrial market became so appealing to us is those B and C sort of multi-tenant or single-tenant, in some cases older industrial buildings, went from $6 gross rents to $9, $10 gross rents overnight. And some of the owners of that real estate were asleep while that was in the cards. Today, a little bit tougher. I don't know if it's so much interest rates, in my opinion, is that it's not a secret anymore. And query whether those rents can go from 9, 10 to 12, 14. Not sure. And there's not a lot of deal flow.
I just want to comment on interest rates. I think yesterday, although the treasuries were down, I fixed through a swap transaction at 6.5%. I feel that's a really reasonable and decent rate in the current circumstance. So the interest rates are somewhat high, what we used to be at 4.5, but 6.5 I can live with.
That's fair.
Well said.
Yeah, it is amazing. There's a lot of people here who haven't seen high interest rates like a 6.5. When I started my career, we were somewhere between 9 and 12%. So it's interesting. People are really upset that they can't get that 3.5 anymore. But 6.5 sure sounds good over the last year.
Remember, you were at 17, 18% in 81, 82.
Nobody remembers that, Akram.
Akram, I do. I remember it.
I remember 14 when I first started. We just locked on a life company portfolio. We just did a $300 million life company portfolio at 5.75 for 20 years, 20-year fixed at 5 3/4. So again, good real estate, find the right lender, and if you can't. And the great thing about doing a rate at 6 or 7%, when that loan rolls over, you're going to be safe again. You're going to be okay. Your leverage will work out.
Dennis, can I ask Joshua whether you really did it at 5 3/4?
Yes.
Yeah, 574 actually.
Thank you, Joshua.
A little more reliable source, just saying.
By the way, embedded in what Dennis just said, is something really, really important. If we have a little bit of a recession, a little bit of a slowdown, and interest rates come in, again, spreads come in, and the 4.25 10-year goes back to a 3 handle or something like that, and you do your real estate deals, remember the possibility that you have a gun at your head at maturity.
Yeah.
Isn't that what you're saying?
Yep.
Okay.
All right. Hey, David, can I ask you a favor? The clock's turned towards
Can I
you. How
mention a
much time
couple
do
of small points that we forgot about CMBS loans? You can assume a CMBS loan for 1% fee. So that's a big flexibility than the recourse loans. So you can, while the recourse loan, you have to pay it down and somebody else can get a new loan. So that's something to add to the CMBS loan.
If Lowell's your lawyer, it's half a point.
Who pays a point?
Yeah, right, right.
Well said.
Half to the lender, half to Lowell.
And one to me.
Lowell, while we're talking about the legal end of things, are you spending more time playing on offense for your clients or defense right now?
Andy, it's a really good question.
Thank you.
I like to wake up every morning thinking that I'm going to go in and play offense all day long. But I would say that I'm probably spending at least half of my time on defense. I think that there is, we've sort of really covered a lot of the sort of financing issues in this panel today, and the reason for that is a good real estate deal often needs financing, and so I would say about half of our time now is trying to work out problem loans or loans that are maybe cash flowing today, but they're going to be a problem in a year. We've got a tremendous amount of debt that's going to mature in the next year, and clients who want to get ahead of the game and understand what are they going to do next year, how are they going to refinance that loan. We're spending a tremendous amount of time on recapitalizations, working with clients to try to find partners today so that they have a plan a year from now. And I think that's a critical part of what we're doing, and so I'd say probably half of what I'm doing is defense.
All right, thank you. I know this panel could go, and we could do 5 more hours together because just an amazing group of people with so much knowledge. I know at the end of the day, everyone's getting excited for the afterglow. But let's open it up to some questions for this, this group. Yes.
For Matthew and David, I didn't hear you talk a lot about bridge. What is bridge is a risky product in today's environment. What is a clever utilization of bridge in a heavy value add type of play?
What's a clever utilization of it?
Yeah.
I don't. You know what? I'm going to use my balance sheet 9 times out of 10 for a bridge, and so I wouldn't highly recommend it unless you'd have to have. If I would have to have high confidence in the turnaround, not only the ability to turn around and stabilize, but the timetable for stabilization. And yeah, I got to tell you something. That is something that even us pros miss sometimes. And so, you're almost by definition playing with fire. Now, every once in a while, I will utilize it. And why will I utilize it? Because it's a bet the farm sort of deal, and I want to take it down, okay, without OPM, other people's money. I want a bigger slice of the deal for myself. I want debt. I don't want equity. And so I would utilize it. But I guess my advice would be this. Those bridge financing is for deals that are in your backyard that you have ultra confidence in.
I would answer it similar. I would say to you, non-recourse bridge loans are very expensive, and the person at the other side, when it comes due, might not be that friendly. So we would use our balance sheet and go to our bank, and so if we're not right on the timing, there's somebody to talk to. Obviously, you got recourse, so you're going to own it, but it's going to be less expensive, and you're going to have a relationship with the person it is that you borrowed the money from.
David, spot on. Know who your bridge, if it's a debt fund, know who your bridge lender is, because they might be loaning to own. They might be waiting for you to blow up on that 10 or 12% bridge that you can't finance out. You didn't hit your metrics, but they're okay owning that one.
By the way, if they are out of the box a loan-to-own lender, they are by definition the person that you cannot do a good deal with, aren't they?
Yep.
That's a good point. All right.
That goes to David's opening point about knowing who you're doing business with.
All right, we're getting notice from Derek. It's time to wrap it up.
Time for tequila.
There you go.
Thank you. How about a round of applause for Andy Gutman? Just a couple couple more announcements. Again, if you heard one word from all of these gentlemen, it was the word relationship over and over and over and over again. And thank you all for your wisdom and mentorship. I do want to bring up Travis Harrison of Signal Restoration, who's sponsoring our cocktail hour. He's got a couple minutes, and then a couple more announcements, and we're done. Thank you, Travis.
Derek, thank you. Thank everybody. What an incredible panel and an amazing afternoon. I did want to take just a brief moment here and introduce Signal Restoration for those of you who aren't already aware of our services and capabilities. As I'm sure this crowd can attest, emergency situations, they come at you fast, right? Often, a lot of this conversation is financial, but in the service sector, disaster, hurricane, fire, or otherwise, that comes lightning fast. How are you preparing your business, and how are you getting your business back on track as soon as possible? In these situations, say 3 in the morning, are your facility managers or your operations, do they know who to call, and are they equipped for that situation? In our line of business, whether it's large or small, an emergency situation can take you out for upwards of months in certain situations. Flooding, fire, mold, as I said, hurricane, as we are in that season right now. Signal on calls here 24/7, 365. We've got a live operator. We've got 25 individuals answering calls 24 hours from everything from a small bathtub overflow in a multifamily all the way up to an industrial complex over hundreds of thousands of feet. So we'll handle everything from that 5,000 bathtub flow over to $200 million projects. Our ownership at Signal Restoration and our Puro Clean franchise business, we've got over 500 locations throughout the U.S., and we've got 3,500 employees on standby right now. So with 50 years in the business, led by our co-CEOs, Frank Torrey and Mark Davis, it's our business to deliver exceptional hospitality and service. And I want to thank Derek in this afternoon, and I will see you guys at the cocktail hour. Thank you.
Thank you, Charles. Appreciate it. Thank you. Once again, thank you to CE Gleason Constructors, Citizen State Bank. We hope you found today worthy of your time. Again, you can approach the stage, introduce yourself to our panelists. Let me know who you need to meet if there was someone you didn't get a chance to. Join us for drinks in the foyer. We will send a survey out tomorrow. Would love to get your feedback and a possibility of a new location in 2025. Thank you so very much. I'll see you in the foyer.